Please welcome to the stage Mac Bell, Managing Director of Infrastructure Investments at Fengate Asset Management.
Good afternoon. It's great to see so many familiar faces. Also to see so many new ones here. My name is Mac Bell. I lead the P3 business at Fengate Asset Management. I am very excited to be here at P3 2025. On a personal note, and I'm probably a little biased, I do feel that the individuals within our sector, the people themselves that make up the P3 industry, are very high quality. I mean that. And so I'm very happy to be here. I'm looking forward to networking and connecting with people at this conference each year. As you may know, Fengate was an early mover in Canadian P3, and we manage some of Canada's oldest P3 projects. With over 100 assets, we manage approximately $23 billion worth of stuff. And our 250 people work on projects in the infrastructure, real estate, and private equity sectors. Our infrastructure group is growing faster than ever before. We are actively investing in infrastructure projects across each of energy transition, digital, social, and transportation. At Fengate, and I think across the country, we continue to see public-private partnerships delivering on some of the most complicated and largest projects in our country's history. We continue to see this country's most reputable contractors accepting and effectively and efficiently pricing risk in most reasonable risk transfer regimes, which is important. We continue to see the DBFM model delivering value for taxpayers across the entire life of assets. To illustrate what lies ahead for our country, I'm very pleased to discuss this with one of the country's most respected economic prognosticators, Don Desjardins, who's the chief economist at Deloitte Canada. Don will take stock of our current political, economical, and demographic landscape and suggest how we can continue to leverage private capital and the infrastructure development community to continue building our nation. Don?
Thank you, Mac. It's a pleasure to be here with you today. And I'm thinking that you might not think it's a pleasure for me to be here by the end of my discussion, but nonetheless, let's give it a go. We certainly know that we are operating in what we would call an uncertain environment. It seems that every time we put, our forecast out, or we think about, have a big discussion about a paper we're going to write, something throws a bit of a spanner in the works. And so, like many of you, we are now working more on a scenario-based basis because it's really difficult, not only for economists, but of course for businesses who are, looking to put money to work to get a return on that capital. And the chart shows us that, we are now in uncharted territories in terms of policy uncertainty. When we think to last fall, we were pretty optimistic about the outlook for Canada's economy. And we thought, a lot of things were coming in line. The Bank of Canada was lowering the policy rate. Labor market seemed in good shape. And with those rate reductions, we thought, okay, well, the Canadian consumer, which as we know is highly indebted, is going to be able to manage through this. And this will see businesses start to put money to work. Well, things changed quite dramatically. And as we got into the early part of 2025, lots of announcements, threats, and we certainly saw a pullback in terms of business and consumer confidence. And although the peak, it seems, and I don't even feel confident saying that, the recent peak in uncertainty seems to be in the rearview mirror. We looked on Liberation Day, and that's when certainly everyone was a bit in shock, and we saw a significant pickup in that uncertainty. So forecasters were quickly, putting everything into their models to say, okay, what does this really mean? And what we saw was a pretty dramatic downgrading of economic forecasts for the global economy, and of course Canada included. And since that time, we have seen some easing in this uncertainty. We've seen the U.S. administration strike deals, whatever those look like, with different partners, and so it's taken a little bit of the edge off in terms of the uncertainty quotient. Not necessarily true for Canada. So we still are operating against a highly uncertain backdrop. And what we've seen in terms of recent forecast changes is that globally, things look slightly better than they did perhaps in April. Still expecting slower growth, but what's interesting is that the U.S. economy has proven to be relatively resilient. I mean, this is the eye of the storm. You would think that perhaps that uncertainty would impact that economy. And so far, what we've seen is a massive increase in investment in AI, in data centers, in technology writ large. And this has, in fact, helped the U.S. economy continue to grow at a rapid rate. Now, our economist in the U.S. anticipates, though, that this is fine for now, but it's certainly not going to be sustained. He anticipates that when you think about the impact that tariffs of goods coming into the United States is going to have on prices over time, the fact that we have seen some deterioration in U.S. business confidence, and the fact that immigration has been dramatically slowed, in fact, actually seeing people leaving the country, he does think that that combination of factors will, in fact, lead to a slowing in the U.S. economy in 2026. Now, it's a slowing, not a stop. He still thinks the economy does have some momentum and will grow at about 1.5%. So down from 2 this year to 1.5. So that's sort of the backdrop we're operating against. Now, for Canada, it's been bumpy. Let's be clear. We certainly have seen data which suggested, okay, companies were front-running in terms of sending exports south of the border. They were front-running those tariffs, and we saw a great lift to our economy as these exports flowed significantly. And at the same time, Canadian companies were importing and building up their inventories. So that gave a pretty good lift to our economy as we entered 2025. But that really fizzled out quite quickly. And as of the second quarter, we saw our exports drop by 25%. I mean, it's quite a substantial drop in terms of activity. And although we did see some more inventory building over time, that too will start to weigh on the economy. Now, the consumer in Canada, kind of bobbing and weaving, I would say, a little bit. As I'll show you, some conditions are favorable. Others really keeping consumers a little bit concerned about the outlook. And when we think about where Canada stands, and I think this is sort of interesting, now, have not incorporated the 10% increase in tariffs in these numbers, but when we think about what's happening for Canadian exporters, we have seen, in fact, any of our exports that are compliant with the Canada-U.S. Mexico Free Trade Agreement actually be able to traverse the border relatively tariff-free. Now, steel and aluminum tariffs, lumber tariffs, finished autos, those are still very much in play, and conceivably, if that 10% increase in tariffs goes through, those could be even more dramatically impacted. But having said that, when you net it all out, when you look at what's being tariffed and what the rate is to being tariffed, Canada's actually not doing that bad. So that's good news. But on the other hand, as I've said earlier, we do think that the U.S. economy is going to start to slow. So yes, it's a good metric if we maintain these carve-outs. And as we know, we're going into the review of that trade deal. But by the same time, we might be selling into an economy that is actually slowing in terms of the pace of economic growth. Well, the Bank of Canada has been really trying to work to insulate the economy. They certainly started that rate reduction in June of 2024 and moved quite aggressively from the 5% rate. They took a pause this spring and early summer, seeing some indications that they were concerned about whether or not these tariffs were actually going to really impact inflation and inflation expectations. Now, more recently, they have, in fact, lowered the policy rate again, and we think they will do so again on Wednesday. So it's always very dangerous to say things like that to an audience when in 2 days they're going to know if you're right or wrong. Having said that, we do believe that in order to help the economy navigate through this very difficult period, the Bank of Canada is going to want to get that policy rate down a little bit. Now, why aren't they going to go to emergency rates? Well, really, don't really think that monetary policy in and of itself is a tool that is going to be able to mitigate the impacts of all these geopolitical factors that are impacting our trade. So we believe they want to keep a little bit of powder dry. So we see them lowering that policy rate to 2.25 and then stepping back to assess what's going on in terms of the rest of the economy. Because another factor we have to take into account is the fact that immigration in Canada, that significant policy change that we saw, is actually going to weigh on the pace of economic growth. We're not going to have as many consumers. We're not going to have as many labor force entrants as we see these immigration numbers come down. Now, we have read, and we'll see what happens, that there is something afoot that may change this policy as we go through 2026. But at the current moment, it does provide some downside risks to the pace of economic growth. Now, Canada's labor market itself has also softened. We've seen job creation on average, because it's an extremely volatile survey, so I try to look at it and averages about 10,000 jobs per month being created. If we think back to 2023, 2024, we're looking between 35 and 45,000 jobs per month. So it's definitely a softening labor market. And the declines that we're seeing in terms of jobs coming in those very impacted sectors, steel and aluminum, impacting manufacturing, so the auto industry. So lots of job reductions in those particular industries, not yet permeating into the wider labor market. And so we have seen the unemployment rate move up to 7.1%. That's the highest outside the pandemic since 2016. So again, we're watching these developments. Now, we're not looking for the unemployment rate to continue to climb, because that labor force part of it is also softening because of the decline we've seen in immigration. So for the consumer, we do think that we're going to see some spending, but as you can see, it's going to be pretty limited spending growth from the consumer sector. They're operating, again, against this extraordinarily uncertain environment. Job creation, Bank of Canada survey recently, they just put it out last week, and they said companies are saying to them, hey, we're not looking to cut our labor force per se. We know that with fewer workers coming into could be some competition if the economy starts to turn around. But by the same token, not looking for big increases in terms of the workforces. So this is going to keep, we think, the Canadian consumer a bit on the back foot. Now, again, as I said earlier, where we previously were thinking, oh my goodness, this refinancing wave is really going to take the Canadian consumer out for the count, as we've seen interest rates move down, it seems that we will see Canadian households being able to navigate as they refinance these mortgages. The gap between where they originated in 2020 and 2021 and where rates are today has narrowed sufficiently. And we know that stress testing that banks put in place in order to get people, stress people in terms of whether or not they give them the mortgage, that gap is probably now in place. So it's not, in our minds anyway, enough to actually get rid of the risk completely, but it has mitigated that risk quite significantly. As I've said, we did see, Canadian businesses saying in the recent survey that, really still extraordinarily worried. We've seen any kind of measure of business confidence come down. We've seen Canadian businesses say, hey, you know what, maybe now is not the time to put money to work, because we don't know if demand's going to hold up from our biggest trading partner, and as well, what's the demand going to look like across the country if we're operating in this really volatile environment. Well, certainly when we think about Canadian companies and investment, it is one of the Achilles heels we've been talking about for Canada's economy. This is just looking at a business investment in the United States compared to business investment in Canada. And you can see there's been an extraordinarily large divergence in terms of our investment activity in this country. And it is one of those things when we're talking about productivity, which has kind of become an obsession, I think. This is one of the factors that is holding us back in terms of increasing productivity. C.D. Howe did a study, and what they said was for each dollar that a U.S. company puts behind a worker, a Canadian company puts 52 cents. So, this is sort of our area. It's certainly the time where we need to see investment flow. And one of the ways to unleash that, of course, is improving our infrastructure, making sure that our companies can see that if they want to sell across the country, if they want to sell to other markets outside the United States, they actually have the ability to do so in a timely and in a cost-effective manner. And so when we look at, this chart I just put in because I think it's interesting that we have seen this compliance on the CUSMA side, and it's certainly been helpful as, again, to get that average tariff rate. It's important that this is being maintained. So this is another, I would say, risk to the outlook. But on the other side, the opportunity, and this is something we've looked quite deeply at, it's looking at things like interprovincial trade barriers. There's just one hurdle that really has to be rectified for our business sector to get money into the economy. And what we determined was if we were able to eliminate non-tariff barriers, interprovincial trade barriers between all the provinces over the next 5 years, because nothing happens quickly, but let's just go with that. Over the following 10 years, we can expect to see $881 billion in GDP compared to a baseline. So that's 2.4% growth, and it is a creator of significant amount of jobs. So while there's lots of challenges right now, there are some things that we can control and can work to remedy, to rectify, to get a situation where Canadian businesses are incented to work. And of course, improving our infrastructure, weighing and leaning into all of these types of big projects, whether it's data centers or clean energy, is really quite instrumental for us to make that migration to a stronger economy. So Matt, did you want to come back up and you can poke holes in this view.
Thank you, Don. That was very good.
See, it wasn't too depressing.
I don't think we're going to poke any holes, but we'd love to hear a little more from an economic climate perspective. Mm-hmm. You talked quite a bit about some of the challenges that Canadian businesses are facing putting capital to work in Canada. What do you think specifically can be done or should we be doing to overcome those challenges?
We've looked at sort of all of these hurdles. It's permitting. Look at any kind of international survey, and Canada is like absolutely in the lowest rung in terms of being able to get, a permit to do something and then have a reasonable expectation that you're going to be able to achieve that. So, they're looking at, if you build a mine, it's going to take 20 years before you're going to get a return on investment because it's layer after layer after layer after layer of regulatory hurdles. And so I think these are the types of things we have to take a hard look at. If that is the case, then can we not work to somehow streamline this process so that Canadian companies, or foreign investors for that matter, put money to work, but they can expect to see a return on that investment in a more reasonable time? Because as we all know, global capital is very fluid, and it's going to go where you can see the returns more quickly. So along with that interprovincial trade barriers, these are other things that we think, it's something we can control that doesn't necessarily, we're not reacting to outside external forces. We're really just looking at our own economy to see, how do we get this to happen?
Sticking with that theme of economic drivers, like infrastructure is often looked at as stabilizing force in an economy. Do you think that prescription still holds true today?
Well, certainly, I think it's it's something that we required. We saw the Prime Minister say, "Oh, we're going to double our exports to markets outside of the United States." Okay, that's great. We know that in general, if we're going north and south across the border, we have rail, we have trucks that do that. But if we want to get our goods to other markets, what about ports? These types of things that we really do need to see some investment in to be able to get these goods out there. It's great in theory to say we're going to do that. And, obviously we've had a bit of a rough ride here with respect to the threats of tariffs, implementation of tariffs, the lingering and looming CUSMA renegotiation or review rather. So, there's lots of stuff that are happening, but we need to be able to say, okay, we're going to get these goods to other markets, to other countries, but it can't be super expensive and it can't be a long time to do anything because no one's going to want to demand that. So I think we have to. It is a stabilization, but it's essential, I think, at this stage.
It's like the nation-building projects. I think you alluded to those a couple times in your presentation as well. One of the things that comes to my mind is do you think we have the government structure right now to actually execute?
Well, I mean, that's one thing, but I think the other, perhaps even bigger issue is the labor to execute.
Right.
We did a study just to say, okay, let's just say this all happens and we're going to be investing in infrastructure and we're going to invest in housing and we're going to do all this. And we looked at, okay, what would be needed to facilitate that? Well, how can this happen? And what we noted is it's about 500,000 jobs, skilled people that be needed in the economy to actually make that happen. So while the government has its own, how's it going to happen? How are they going to negotiate, with First Nations, Indigenous leaders? Like that's one thing. But even just say it all goes smoothly, we are still in a situation where we may not be able to do it just because we don't have the labor.
That's fair. What do you think the role for private capitalists is? A conference with a lot of private investors and those that represent institutional private capital. Right. Is there a role, and what metrics should we be watching for private capital in the infrastructure build out?
Well, I certainly think there's a role. I was just looking at some data, and in recent years we have seen almost a 50-50 split between the public sector and the private side in terms of putting money into the infrastructure world. And so we need that, I think, to continue. I mean, the government, I think, can be a facilitator and, actually be a support to get the projects going, to get the money available to private investors. But then you need to have the expertise to be able to really move them along and move them along in an expedient way. I think that's sort of one of the things that we keep coming back to. And I sort of feel like when I'm giving these presentations, it's kind of like, yeah, this is all going to be great, but we know it's not going to happen quickly. So how do we incent companies to get money to work so we can, first of all, get labor, increase in terms of building the economy. That also ripples out, of course, labor market to the consumer. But we certainly need to see the private sector in there as well.
I would obviously like to see the private sector because I'm biased.
You are biased.
Involved. What do you think we could learn from the United States and how they have encouraged private capital in their projects?
Well, I mean, certainly they have done things that are, extraordinary when you think about the AI boom that they're experiencing right now, really trying to subsidize and work with the private side to get companies to invest. Now, I mean, they're a little bit considerably different, I guess I'd say, than Canada, and they have, changed some of their tax rates, et cetera. So we, I think it is trying to figure out how we just incentivize companies to see that return on investment, because that, I think, is the biggest problem. And so it does. It means, what can we learn? Well, we learn how to make the system smoother. You talk to any businesses about what, well, they're like, yeah, that's great. There's lots of tax incentives, but it's really hard to get to them. Like, it's just, the list is long. It takes way too long. So, I'll take a pass. So how do we just grease that wheels to ensure that having the incentives there, but also making it easier for companies to access them, to get that ball rolling, so to speak.
You talked about artificial intelligence. Do you think that is a big opportunity for Canada?
Yeah. I mean, when we look at sort of the great ideas of AI, we know they came from Canada. And so when we look now at the investment side, certainly the U.S., the top 10 stocks are going mad because there's just so much investment activity going on there. But we have a lot of things here, I think, that are supportive of us, taking advantage of it. We have an educated workforce. We have energy. Now, you might have to catalyze that and really boost that up, but these are the types of things that I think we can take advantage of and use to our advantage. The other thing, I guess I would say, is with Canada, one of the things we've noticed is the adoption rates are lower than south of the border. And some of that might reflect the fact that we're a country of small, medium-sized businesses, and it's really hard to figure out how to adopt AI, some of these technological tools to improve their productivity. But having said that, it's not out of the question. And we have to, I think, incent Canadian companies to grow. Because once you get sort of that economies of scale, and whether it's growing because I can now export across the country, that's great. If your sales market grows significantly, you're going to have that incentive. So you start to grow, then you start to take advantage of all of these tools, technological tools that will help in terms of our productivity and our efficiency, because that really right now is sort of where we're kind of sand in the gears, if you will. So I do think that we have to figure out ways to help companies adopt some of these tools, and we have to invest because we have a lot of the good things that are needed. Critical minerals, we really are in a pretty advantageous spot. We just have to lean in a little harder, I guess.
And do you see any benefits or intersections for the infrastructure community with artificial intelligence?
Yeah, I mean, I think, sure. I mean, anyone where you have a chance to invest, whether it's in the data centers or in the energy space, I mean, these are huge opportunities. And I think that that's where we're seeing the growth right now. Now, there's obviously risks, and there's always winners and losers. You see these big, run-ups. I'm not going to say the word bubble, but, you see these big, huge rallies in terms of investment in certain technologies or in certain, whatever, cable in the night. So you have seen things before, but at the same time, I do think that is, it is an opportunity. We don't have to, bet the whole farm, but certainly I think investing in those types of projects, it's going to help us move up that curve. And, our productivity, that links to our living standards. So we need to really start to move.
Awesome. That's all I had for you myself, but I don't know if we have time I'm looking for someone who can be an authority on the matter. If we have time for any audience questions. I don't know if you're planning on audience questions, but, I think we'll conclude there because I think we're actually getting low on time anyway, so there we go. All right, well, thank you very much, Dawn. That was very informative, so thank you for your time today.
Oh, my pleasure. Thank you.